Welcome back, friends, to Alpha Beta Soup. I'm TXMC. What is a recession? Are we in one now? Did we have a recession in 2022? Who's in charge of determining those things? Have they changed the way they define one? All of these questions have been on the lips of everyone discussing the macroeconomy for the last year and a half. And I'd like to dispel some of these myths and show you guys a lot of what I've learned over the last 6 or 9 months as I have been exploring this topic in depth. So the subject of today's video and the next couple will be about recessions broadly, but we'll do it in multiple parts because it's far too much to cram into a single video. I want to make it digestible for you. In today's video, we'll look at what is an official recession, which metrics define them, what do they look like, and how do they appear today. And then in subsequent videos, we're going to talk about what else I have found. I've expanded my methodology beyond what the NBER does. I've applied many more facets of the economy to that study, and I've come up with an event sequence. And we can use that kind of profile and apply it to today's events and see what it looks like. See if there are markers that indicate we may be about to experience a recession for ourselves. So let's get into all that. But before we get started, disclaimer, I do not have a background in finance. Nothing on this channel is meant to be investment advice. Please do not make decisions based on things I say. With that, let's get started. So who are the NBER? Well, they are the National Bureau of Economic Research, and they are the group that has been in charge of officially dating U.S. recessions for decades. Their methodology is on their website. All the dates of the prior recessions are on there, but very few people take the time to go read them. They're also the source of a lot of great economic research if you're into reading that kind of stuff. But let's focus on what they call business cycle dating, which are the recessions. So there's a lot of talk about what is a recession, how is it defined, which metrics actually are used in assessing those things. And if you go look at their page, they will tell you exactly what it is and how they measure it. The NBER's definition says a recession involves a significant decline in economic activity spread across the economy lasting more than a few months. They have 3 criteria: depth, diffusion, and duration. They're interchangeable. One of them could be extreme while others could be weak, and that could indicate a recession. For example, in 2020, the committee concluded that the drop in activity was so great and so widely diffused through the economy that even if it was quite brief, the downturn should be classified as a recession. And if you go look, you can see they dated the 2020 recession from February to April. It was only 2 months, and that is the shortest recession in U.S. history as long as this process has been going on. But what do they use to measure those things? Well, they tell you right here. There is a basket of indicators that they use. Most of them are monthly, but they have a couple of quarterly ones as well. The monthly ones are mostly real metrics, meaning that they are adjusted for inflation. They are real personal income minus transfer payments from the government, non-farm payrolls, household payrolls, real PCE, wholesale and retail sales, and industrial production. They also mention that on a quarterly basis, they look at GDP and gross domestic income, which are kind of 2 sides of the same coin, but those come a little more slowly. There are people who believe that the NBER uses real GDP as its definition of recession, and that's how it's always been. And when we had 2 quarters of negative GDP at the beginning of last year, a lot of people assumed that meant we had a recession. But then as the year went on, and it was never called that, and many people that follow the economy and the markets never corroborated those things and started saying things like, we haven't had a recession. Well, a lot of people got confused. People thought that maybe the US had stealthily changed the definition of recession behind the curtain in an effort to move the goalposts. But in truth, real GDP has never been the criteria that the NBER uses. They talk about that on their website. The financial press often states that a recession is 2 consecutive quarters of negative real GDP. And they say most of the recessions identified by our procedure do consist of 2 or more consecutive real GDP prints, but not all of them. In 2001, for example, the recession did not do that. Why doesn't the committee accept the 2-quarter definition? It seems nice and simple, right? Why don't we just use that? We don't identify economic activity solely with real GDP. GDP, but we use a range of indicators. We also consider the depth of the decline in the economy. So they have like a layered approach to this. There are a few metrics they look at. They look at them in concert with one another. They have criteria about their diffusion, the duration of them, how deep they go, and then they talk amongst themselves. I think that is the best approach. I think that's a far better approach than having a single metric that is all powerful that we can just all set alerts for when it goes negative. That's not as simple as really anything ever happens. And there's a lot of just straight up falsehood propagated on Twitter and in macro circles that we had a recession at the beginning of 2022 and that the US is trying to trick everyone and change the rules. And that is just a straight up lie that has never been true. So they tell us they've got all of these metrics. They got income, payrolls, consumption, wholesale and retail sales, industrial production. Those are the things that they want to look at. So let's go look at those things. Here are those metrics. Here they are, all color coordinated. I'll move my legend down at the bottom so you can see it. Very nice and pretty. Now, these metrics are not being shown as an index. There is an index over here. This is what they look like normally. They just kind of go up and up and up and up and up forever. And there are these brief periods where they turn down. For the most part, all of these metrics, employment, production, sales, incomes, PCE, all that stuff, are forever up and to the right, almost perpetually, to the point where you can really easily just measure them as a drawdown from their all-time high at any point in time and get a reasonable estimation of how strong or weak they are. And that is what we're looking at here. This is each one of those metrics as their drawdown from their all-time high. Up here at the top, we've got employment. Here in the middle, we've got the cyclical parts of the economy, sales, manufacturing, and then we've got incomes and consumption. And what you'll notice is most of the time, these metrics stay at or near their highs. That's what's indicated by the line just kind of going straight. It means it's not drawing down. But you'll see in the case of employment, it only really draws down in recessions, which are these gray bars, and almost no other times does it occur. The same thing for the household employment, though it is a little more choppy. It's less smooth, but for the most part, the big drawdowns, the ones you really notice, those are recessions, and everything else is mostly just up and to the right. Now, some other metrics are a little softer. They maybe give you a hint sooner than others, like industrial production here. You can see it's got a lot more dips, a little bit of fake outs. Sometimes it goes lower and there's not actually a recession attached to it. Other things like real retail sales, they can get weak many months in advance and they can drift down into the recession, which we often see happening. So they each have their own behaviors. They kind of have their own dynamics to them. And that's why it's important not to just look at one or even just to look at two of them, but to see the host of them and look at them in context with one another. So here are each of those metrics, but they are blended together. You can see in the bottom right, I've combined a bunch of different eras. I have dated these eras myself. They are based on the official dates of the recessions per the NBER. And we're using a bunch of them going back to 1960, except for COVID. We leave out COVID because when I include COVID, because of how dramatic it was, it makes everything look insane 2 months into the recession. So we're going to leave COVID out for now. And what this is showing is the 3-month growth rate of each of the metrics that the NBER says are important. And it's a 3-month annualized. So I take the rate of change over a quarter and then I multiply it by 4 to get a hypothetical yearly growth rate. And the x-axis is the amount of months before or into the recession. So back here at -12, this is 1 year before the recession. 0 is when it begins, and the positive values are the months into the recession. And what you can notice, the first thing that really jumped out at me when I made this visualization is that a lot of these metrics can look quite positive up until the point we're actually in a recession. They don't necessarily all soften beforehand and then we wake up and go, wow, everything's at 0. We must be in a recession. If you look at things like non-farm and household employment, they can stay positive until we're in the recession, until maybe 2, 3, 4 months into the recession when they really start to decline and their growth rates turn negative. Same thing down here for consumption and income. These things can stay pretty resilient. And you can could see maybe a gentle slowing of their growth rates as we get closer to when a recession hits, but nothing that would really set off alarm bells if you were just looking at real PCE, right? Not until we got into the recession and it finally dipped negative for a few months. But there are other things like these three in the middle here that do get a bit softer. They start to look a little weaker months in advance. These are industrial production, real manufacturing and trade sales, which is wholesale, and then real retail sales. And you can see these three look quite a bit different from these over here, right? Which stay much stronger even into the downturn itself before they finally buckle on an average basis when you combine all of the eras. It's of course worth pointing out every recession is different. Everyone has its own footprint, its own signature. They are not all identical, but when we combine them together, we can read the trends and get informed about how these things happen. So the real takeaway from this visual here, first, it's obvious things can stay positive until they just aren't, and there are certain things that look weaker than others, and they tend to revolve around the goods sector, around the productive part of the economy. Production, wholesale, retail. Here's another look. Same metrics, but now we're looking at them in a drawdown fashion. Drawdowns from the all-time high in the months up to, starting, and into the recession. Take a moment to observe this chart. You'll notice there are 2 or 3 metrics that look very different from the other 4. Now, these 3 look very weak, and in starting a year out from a recession, they can really start to draw down and show softness. But at the same time, household employment, consumption, non-farm payrolls, personal income, those things don't look nearly as bad. They look more resilient, maybe a little bit more chop, perhaps even still expanding. Whereas things like manufacturing sales, industrial production, and real retail sales, those 3 begin softening months in advance. Now, this view is corroborated by this view. These are those same 3 metrics. Notice the softening months into the recession, heading in. These are their growth rates. These are their drawdowns from their all-time highs. So 2 different perspectives of the data, both showing confluence, that we have the goods sector, manufacturing, industrial production, real retail sales. Those things tend to soften first and give us the hint that the economy is weakening. And then once we actually get into the recession and things start to slow down more broadly, that's when labor and consumption and incomes really start to catch up. Here's another view of the same data, right? Let's look at it together here. Here's the months leading into the recession. Here is the recession, right? Month 1. Now, what you'll see, these are monthly growth rates, right? These are the number versions of what produced the chart we were looking at a moment ago. And what you can see is, I've got averages and medians, by the way, just so we can have a little bit of mathematical integrity here and not just look at the averages. So we've got average and medium household employment, average and medium industrial production, consumption, etc. The things that jump out to me, most of these metrics can stay relatively positive up until the day the recession begins. This is when the recession begins. And you can see household employment, consumption, incomes, all of these can have positive growth rates up until the point when they just suddenly don't anymore. And you'll notice month 2, 3, 4, 5, 6 of the recession, virtually everything has a negative growth rate. But there are parts of this that start to soften first, right? Look, you can see in here, a little bit of softness, a little bit of softness here, some softness here, here's some right here, here's some right here, and obviously there's a lot down here. Well, what are these metrics? Well, they are industrial production, manufacturing sales, and retail sales. Those are the ones we've been talking about. If we go look at our drawdown chart over here, that's those 3 metrics here. And if we look at this view, it's those 3 metrics. So we're seeing confluence, that things like retail sales, manufacturing sales, and industrial production, they start to soften while everything else is continuing to expand up into the moment when the recession is just unavoidable and everything begins declining at once. It's not abrupt. It's not like we wake up on one day and it happens. Remember, each of these metrics come out on a monthly basis and they all come out on different days. So this unfolds over a series of months, and it's something that you don't notice happening unless you're really plugged into the data. So we've established that metrics can look good until they kind of aren't anymore, right? Things can grow until they just sort of fall off a cliff. And in many cases, we can see positive growth prints across the economy up until the point when everything just can't keep going. There's a breaking point. There's some period where the ice is too thin and the skates penetrate and we just can't stay aloft. That's different in each recession. It's caused by different things, but these patterns have a consistency to them. So now that we've established some of these trends and these metrics, can we look at today and glean anything from it? And I think we can. Here are all of those metrics again. Here they are in drawdown fashion, and these bars are the recessions themselves. And you'll notice, again, most of them do stay near the highs until they draw down, and those periods mostly align with these gray bars, and virtually only during the gray bars on most metrics. Now cast your eyes over to the right side of the screen. We've got these black numbers next to each line, and that represents the current drawdown from the all-time high as of the most recent print of each of these. Only 3 metrics are showing a drawdown. Which 3 are they? They are these 3. Which 3 are those? Industrial production, manufacturing sales, and retail sales. The 3 musketeers, the ones we've been talking about this whole video. They're the ones down here at the bottom of the chart, rolling over while employment and income and consumption stay very high. So when we take this picture together that we've been talking about the metrics the NBER uses, the order that they normally unfold in, certain sectors leading other sectors, and then we look at today and we see these 3 drawing down while others remain really stout. And then we think about what people on Twitter are talking about. They're talking about strong consumption. They're talking about a strong labor market. They're talking about how incomes remain very strong. But friends, that doesn't necessarily mean anything. Incomes can be strong. Employment can be strong. Consumption can be strong until it just isn't anymore. But at the same time, what are the other parts of the market and the economy telling us right now? What are they saying? And right now they're saying there is softness. Now these values, these drawdowns, are not deep enough that we can say we're in a recession now. Like if you look at real retail sales, it normally draws down 5 or 10%. That's what 0.1 is right here. 5 or 10% in most recessions, it's only at 3%. Real manufacturing sales usually also draws down about 10 or 15%. That's what this second 0.1 is here. Usually 10, 15, maybe 20%. Right now it's only at 1.5%. Right? Industrial production also up here near the highs hasn't really completely rolled over. It still looks like it's kind of recovering from COVID, even though the actual high was in September. Maybe we get a fake out. Maybe this jumps back up into expansion for a few months. It could certainly do that, because if we look at these growth rates over here, just look at industrial production. Look, it can soften and then go positive again and then soften again. Same thing with manufacturing sales. Positive, really strong. Negative, strong. Then it dips negative and it just doesn't recover, and that's the recession. Real retail sales, they can also oscillate. These values get deeper, softer, deeper, softer. It's non-linear. That's the story here. It doesn't happen all at once. It doesn't happen in a fixed sequence. And when you get a peak in a metric, that doesn't mean it is for sure the peak. However, the pattern here is pretty clear. The goods side of the economy is weakening. The services and labor sides of the economy remain strong, and that suggests to us maybe we're in the early windows of a recession if we think one is possible, if we see other things going on in the markets and the economy that make us on high alert for a recession. And I think we've got some of those signals. In the previous video, we talked about the yield curve inversion that has a 100% accuracy on calling recessions. It is currently inverted. When you look at the Federal Reserve's projections for economic data, assuming that they get to carry out their policies, they show an unemployment rate rising to a level that only happens in recessions. So we have some signals laid out in front of us that suggest maybe we need that outcome. Even more so when you add on the historical fact that the US has never experienced 5% CPI and escaped it without a recession. All of these factors, when you add them up and then you throw on this truth that we just explored here, I am on high alert. It's why I still consider a recession to be a high likely outcome. come. And we'll talk a little more in the next couple of videos, about what we can look for, other things of the economy that are kind of corroborating that things aren't right, and how can we tease out a potential timing of these things. We'll go through those over the next couple videos. But today, this is what I want to focus on. I want to focus on the NBER's metrics of import. The real takeaway for today's video is we looked at the NBER. We have established that they have a basket of metrics that they pay attention to. They consistently all turn down in recessions and expand otherwise. So if we start to see weakness across this basket, we can be on alert. And as we see now, as we have explored, some metrics soften before others. They tend to be the good side of the economy: industrial production, real manufacturing sales, real retail sales, and those metrics are the ones currently in contraction. So take what we've talked about today, let it kind of seep down into your brain, let it digest as I take the next day or two to put my thoughts together, because we need to go the next step. There's a lot of other aspects of the economy we can look at. We can take a gander at many recessions of the past, and then we can start to apply some methodology to the sequence of events that play out, and then determine, where do the market lows and highs line up with these various events? What does that say about where the S&P might go? And then we'll move even forward and apply those things to Bitcoin. But that comes at the end, right? We need to establish the groundwork, and this is part one of that. So that was a lot. If you have any feedback or questions about what we talked about today, make sure to leave it down below. I really appreciate all of you giving me your feedback about the channel, as I asked for in the previous video. I might not reply to all of your comments, but I assure you that I have read all of them. I take them to heart. I am so grateful to have your support. I'll be using your feedback to help guide my planning for the channel going forward. But for now, we will leave our discussion where we ended it today. We will set it up for the next time. I'll try to get a video out maybe in the next 36 hours. It might take me 48, depending on how long it takes to get my head around how to present the next set of data, because this is a big conversation. There's a lot of elements to it, and it's up to me to decide what's most important to show you. So that's where we'll leave it today. Make sure you follow me on Twitter at TXMCTrades, my main account. It's where I post all day long. I'm a DGen. My DMs are open if you want to reach out. And yeah, that will be the end for today's vid. Thank you so much. Hope you guys are having a great Wednesday. I'm about to get outside and play some disc golf after I publish this video, go touch some grass, get some sunlight, some natural vitamin D, and I will talk to all of you in a day or two. So until then, take care of yourselves, friends. Take care of each other, and we will chat very soon. Cheers, everyone.